Hi, welcome to a brand new business video where today we're going to be covering the topic income statements, which is chapter number 23. So let's consider the importance of accounts. We've talked about one of the important functions of a finance department is to create financial accounts. So financial records are very important because you need to keep track of what a firm's transactions are. So normally you have accountants who draw up accounts that keep track of these transactions. This includes you paying off invoices, you're paying off expenses, or the sales you make and all the other incomes you receive. So accountants will periodically draw up final accounts for its users. Final accounts could be the financial statements that you produce include the balance sheet, the income statement, and the cash flow forecast. So sometimes these are required by law for your companies to produce. So company performance can be analyzed when you go through these final accounts because they provide details regarding the performance and the net worth of the business. You also think about, we've discussed already, where public companies are required by law to annually publish. So when you go online, you can think about any major companies that are publicly traded on the stock market, and you could essentially find their final accounts for those years online. So transactions nowadays are recorded in computerized system, which makes it very accessible, and it could be because your database are now linked, you could draw up final accounts more conveniently. So let's talk about the main parts of an income statement. We start off with trying to understand what a profit really is for a business. So profit is the surplus of revenues that remain after you pay off your expenses or your costs. So a business can increase your profits by trying to increase revenue by selling more or trying to reduce costs. So profit is one of the most important goals for most organizations because of most private sector businesses aim for profit maximization. Profit stands for a reward for investment for you as an owner, because every time you're investing money in a business, there's a risk that you could actually lose all of your money. So this is for that you have to get a reward, and profit is your reward. Profit is also used as a source of finance for future needs. You can also profit is also an indicator for performance. So you try to analyze how much profit you've made during the year, and it could show the efficiency with which your organization is being run, and you can compare it to your competitors to understand your position in the industry. So let's look at the income statements in more detail. So we start off with trying to understand gross profit. So an income statement records all the income and expenditure during the period. Gross profit is the surplus that you generate from sales, and you try to deduct the cost of goods, or these are all the costs that it went directly into manufacturing the goods, calculated in the trading account. So trading account is the first part of your income statement. So sales revenue is all the income that is generated from selling your goods. This includes cash sales and credit sales. And cost of goods is the total cost of production to bringing the goods into saleable condition. So everything that went directly into manufacturing the goods that you've sold during the period is considered as costs of goods sold. Then we move on to calculating net profit and retained profit. So net profit is the profit that you generate after all the costs are deducted from sales revenue. Remember, when we're calculating gross profit, we're just deducting the cost of production. Here we're trying to deduct all the other costs that are incurred while your business activities go on. One of these costs include depreciation, which is the fall in value over a fixed asset over time. So think about a motor vehicle or a car that you're using. As soon as you bring out a car for a test drive, its value falls because it's being used. Similarly, think about your cell phone or any other assets that you have, your personal possession. As soon as you use it for a year or two, the price of itself falls over time. This is why accounting generally includes a treatment called depreciation, where you try to account for the fall of assets value over time. It's not a real treatment. It's an adjustment, but you can't really see it. But it is necessary, because in essence, only when you sell the asset can you really understand how much its value has fallen. But we in accounting try to account for it by providing for this adjustment. So let's move on to retained profit, which is the profit that is invested into a company after tax and payments such as dividends. We already talked about dividends being those distribution from profits to shareholders as a reward for their investment. So income statements generally include tax paid. So this is corporate tax paid on profits, and dividends distributed over time. And we talk generally when we're producing final accounts or income statements, part of the final accounts, we provide comparison for previous years so that the users of financial statements can easily compare performance between last year and this year, whether we've been more efficient in terms of costs or whether we've been better in terms of sales, or how much have we been affected by different factors. So let's look at users of income statement. So we have managers who try to make use of income statements in order to make best decisions. So managers try to understand the impact of certain decisions they've taken during the year. So they could look at whether marketing campaign has helped increase their sales, or how much the costs have been increased that affected net profit because of the marketing campaign, which could be because you took a marketing campaign, the impact of it could be in the future rather than its current financial period. So you also try to understand how new fixed assets have impacted performance. Because new fixed assets, generally sometimes you could have depreciation which is much higher and affects your accounts at an earlier stage, means in the current first year rather than in the future. So if you have a lot of new fixed assets, it could be that those assets were bought at the end of the year, and in the future your those assets would be put into perfect use. So when you're trying to make decisions, you're trying to analyze and evaluate your past decisions and the impact of it in the income statement.